After transactions have been recorded and summarized, reports are prepared for users. The accounting reports providing this information are called financial statements. So we are now working on financial statements. Of course, we know there are 4 financial statements: balance sheet, income statement, owner's equity statement, and the cash flow statement. Those are the 4 statements that we deal with in financial accounting. So we have income statement, which is a summary of revenue and expenses for a specific period of time, such as a month or a year. Then we have statement of owner's equity, which is a summary of the changes in the owner's equity that occurred during a specific period of time, such as a month or a year. Then you have your balance sheet, which is a list of your assets on one side, liabilities and owner's equity on the other side, as of a specific date, usually at the close of the last day of a month or a year. Then you have your statement of cash flows, a summary of the cash receipts and cash payments for a specific period of time, such as a month or a year. That was the last thing we discussed yesterday. The income statement reports the revenues and expenses for a period of time based on the matching concept. The matching concept is another concept. It's one of those principles that we value so highly in accounting. In accounting, you have to match your expenditure to your revenue. If I want to report a lot of profit, I can choose to ignore my expenses. So I purchase something for $5 and I sell it for $10. But I have to pay somebody to help me take that item to the buyer. I paid $3. So how much is my profit now?
10, 7? You said 10, you paid, $5?
You said you bought it for $5, but you sold it for 10. So that's a profit of $5.
But I paid somebody $2 to take it to the buyer.
So $3.
So I made only $3. But if I want to think that I made too much profit, I will ignore the $2 that I paid that person to take it to. And a lot of people do that. Well, the matching concept says no, you cannot do that. You got to record all the costs. Your real profit is only $3. It is not $5.
Now, why would you ignore that?
Just to show that you made a lot of profit. For some people, it's a mental thing. Some people forget. They forget that they paid $2 to get the product to the buyer. They just don't know accounting. Some people just don't know accounting. They just don't know.
But that should have been a pocket expense,
Yeah, but it's still your expense, even if it is out of pocket.
So they want you to record every single thing
that is related to a particular revenue. If you want to ignore your revenue, that's on you. But if you are going to say you made revenue, you earned revenue and you made profit, then you better give us the true picture. Don't give us half the picture. We don't want you to tell us about the $5 and just forget about the $2 because you chose to. You got to tell us about the $2 as well as the $5.
But what's the significance of the $2?
$2 is 20% of your revenue. That's huge. Mm-hmm. And it's 40% of your profit. That's even bigger.
Right, because I'm giving away $2 that I'm not reporting. I'm giving away money.
So 40% of your profit is huge. That's really huge. It's not small. Well, the matching concept is applied by matching the expenses incurred during a period with the revenue that those expenses generated. The excess of revenue over expenses is called net income, net profit or earnings. And if you spend more money than you actually make, then it's a loss. It can be huge, especially if you spend too much money. Some people want to show profit even when they are losing. And that's why a lot of companies were told to go and redo their books because they did not include everything that they were supposed to include. The revenue and expenses of Chickadee travel service for the year ended April 30th, 2012, and this says the goal. You have fees earned 263,200. Miscellaneous expense. How do you calculate income statement? How do you prepare your income statement? Here, all you have to remember is the formula. Income statement is always revenue minus expenses equals net income, right? So here, you identify your revenue. This is the only revenue you have there. All the other ones are expenses. So if you deduct all these from that, you will get your net profit. So the main thing here is identifying the various items, what belongs to where. So here, and arrangement is also very important. You go to income statement, you got to remember your title, income statement of the company as for the period ending. That's very important too. Ending, then you write the period, April 30th, 2012. You got to remember that. Now you start with your fees and you go all the way. Always remember to use 2 columns for these things. Makes life a lot easier for all the people that are trying to read your work. Less expenses. You have your expenses there, and you have miscellaneous expense. Remember to indent office expense. And then you have your wages expense. So you have your 12,950, 63,000, and 131,700. You add everything together, and you take it to the next column. The difference between the two becomes your net. Yes, the net income of a period. So when you add all these 3 together, what do you get?
Is that a 9?
Yes, 12,950. 12,950 plus 63,000 plus 131,700.
150,950.
150. Huh?
Yeah.
9.
Oh, 150,950.
950. And the difference between the two, deduct 150.
Oh no, that's wrong. Do you know why? I did 6,300, not 63,000. So it's
I'll do it.
again.
263.
207,650.
27650 minus 263,200 will give you what?
55,550.
55,550. 50.
Is that right?
And that's your income statement.
Yeah.
So as long as you remember that revenue minus expenses is what you're shooting for in order to get your net income, and you indent them properly, then you're good. So that's a very simple form of income statement right there. We just rearrange the number. We just put the numbers together, and
It took me 99 years to write that out.
huh?
I said it took me 99 years to write that out, and all you did was put down fees earned, put it way over there in the corner, and then you put miscellaneous expense, office expense, and wages right there, and then you just add them up.
And then you deduct that from
It
that.
took us so long to write that, just to write that out like that. I mean, it took us like 30 minutes to write all that stuff out.
Because you are writing it for the first time.
I need to sit over in the corner by myself somewhere so I can focus.
Then we have the next one. The statement of owner's equity. Statement of owner's equity is, in simple terms, a statement that shows what we owe the investor, the owner of the business. That's all. That's what it is. We just want to find out how much we owe the owner of the business. And if you want to break it down in a very simple language, it means how much did he invest at the beginning of the year? That's the beginning balance. During the year, did he invest anything? We add that to what he started with at the beginning of the year. How much profit did we make that we did not give to him? We add that to the mix because profit belongs to the investors. And finally, how much did he withdraw from the company? Done. So whatever he withdrew from the company, we deduct from the total of all those, and then we know how much we
In
owe.
the end, yeah.
That's what the statement of owner's equity is about. And that's why we cannot prepare it before we prepare the income statement. Because the income statement is what's going to tell us how much profit we make. And whatever profit we make belongs to him. It's part of his money. The statement of owner's equity reports changes in owner's equity for a period of time. It is prepared after the income statement. Because the net income and net loss for the period must be reported in this statement. It's part of this statement. We have to include it in the statement because it is its money. The profit of the company belongs to the owner of the business. Using the income statement for Chikadi Travel shown in example exercise 1.4, prepare a statement of owner's equity for the year ended April 30th, 2012. Adam Salini, the owner, invested an additional $50,000 in the business, withdrew cash of $30,000 for personal use during the year. The capital at the beginning of the year was $80,000. How much is the owner's capital at the end of the year? So you start with beginning balance, beginning capital, $80,000. So you have $80,000. And then you have, during the year, he invested additional 50. Investment during the year How much? How much was the investment during the year?
50,000.
Huh? 50,000, thank you. So altogether, we have how much?
The net income was 55,500.
Okay, so we had net income 55,550. Actually, 80,000 should be here. So.
Yeah. What you gonna do with that 30,000?
So we had all these together. Which 30,000?
It's not the less, but you do that
It
after.
says Drew.
Yes, we do that later.
Yeah.
Oh, okay.
So it's 105,550.
Okay, so we have 105,550, and then less, right?
So 30,000.
Drawings, right?
Withdrawals.
30,000.
What's that 55,000? Oh, that came from our last one.
That came
Yeah,
from
from the net income. So we have 75, right?
75,550.
75,550. We add that, and that will give us
155,550.
what else are we missing? Is there anything else left?
Increase. That's the increase. That you didn't write the increase in owners underneath drawings. The 75 is the increase. So instead of increase, you can put net. Oh, you put net increase.
Mm-hmm.
And then the last one is Adam, his capital, which is the 155. So if we were to just work it out but not write those last two things, would that be incorrect? Like
Yes.
all the way. So would you mark it completely wrong, or would you just take points off?
Points off.
So you have to remember that. Okay. So do you have to write it out complete like that? Could you just write capital?
Adam Salini's capital is
So you have
fine.
to write the full.
It's fine. You can leave it there.
Okay.
So that's your statement of finance equity. Again. So essentially what we are worried about is, of course, don't forget your title. Sorry, Chica didn't travel.
So yeah. Capital.
So now we have to go into prepare the balance sheet.
That's wrong. That's wrong. Right here. Or net increase. And you're gonna take that 80,000 and subtract it from that 75, right? Oh, you
We'll add
add
it.
Oh, add it. You always add that?
Yes, unless
Unless it's
the net income is a negative.
Right. Oh, okay. It had been in parentheses or a negative. and we would subtract it. And that would call the, oh, that's his capital at the bottom. Okay.
Yeah, I'm showing his capital at the end of the year.
And this was, and that was a income, what's it called? That's a statement. What was that one we just did? Income,
That was statement of owner's equity.
no, that one we did, the one we just did was
Oh,
called what?
income statement.
Income
Income
statement.
statement.
I remember the order.
Hmm?
I remember the order.
The balance,
I
the
say
income, and then.
IOE cash. That's the only way I remember it. Income statement, owner's equity, balance.
Balance sheet.
Cash
and
flows.
cash flows.
But the order of preparation is going to be your, you're going to do your balance sheet first, then your income, and then your income, and then your, when you're, like, isn't that, don't you have an order of operation to do your, to do these
Statements? Yes, you do. You start with income first,
Income, then your balance.
then owner's equity,
Balance, cash flow.
and then you do the balance sheet, and then the cash statement.
Oh. Is that going to be on the test?
Oh, I was going to ask about this. I am good at asking about this. I need to know.
The test is not that difficult.
Oh, it's not?
To you,
What?
will we be required to fill one of these out?
Let's when you see the test, you will
And you can only take it once. You can't.
only one.
If you mess up, no. So best you can't do best out of 3. No.
It's only one time. But you will see that it's not that difficult. Here is again a recap. You see your net income there, total expense, wages expense, rent expense, supplies expense, utilities expense. We didn't have to deal with those two before. Your net income is always carried to the statement of owner's equity. And then you have a statement of owner's equity, which is where you had your net income from. Where you had to use your net income. While the final value of your capital will be transferred to the balance sheet. We are going to need it when we prepare the balance sheet. That's why you cannot forget it. So what's the balance sheet? The balance sheet is a list of the assets, liabilities, and owner's equity as of a specific date. It's a statement of what you have and where you got the things you have from as at a specific date. So you have assets, liabilities, and owner's equity. There are a few different ways of preparing your balance sheet. One of them is the account form. The account form, you have assets on the left and your liabilities and owner's equities on the right. Resembles the basic format of the accounting equation. Simple form. And that's what it looks like. You have assets on one side and liabilities and owner's equities on the other side. One thing that is unique about your balance sheet is both sides must equal when you're done. Because it's a balance sheet, both sides must balance. The amount to be, you are going to do this amount when you prepare a cash flow statement. The final figure that you have in your cash flow statement must be the same as your cash amount in your balance sheet. That's the only way you know if they're right or wrong. Plus, your Chris Clark capital came from owner's equity statement. So we have a question here. So using the data that you had before, prepare your balance sheet. Well, we're using the account form. So we have assets on this side, and then we have liabilities first, right? And then we have owner's equity. Well, owner's equity is from the last assignment, right? Which was Chris Clark.
What are you looking for?
The capital amount we had before was 155, right?
Yeah, 550.
550. So we have that going for us. You know, the rest is just to sort these out, find out where they belong, put them there, and we're done. So your cash, remember, assets are always ordered
Yes.
in the order of liquidity. How liquid they are, how quickly you can convert them to cash. And because cash is already cash, it will be number one. After that, you have accounts. Accounts
Oh, I see that.
comes
Right.
first. Yeah. So your cash is 53,050. Your accounts receivable is at
31,350.
350. Then you have supplies.
3350.
Supplies
3,350.
350. And you
Land
have land,
80,000.
which is 80,000. You add all those up. Then you have liabilities, right? Which is your
Accounts payable
accounts payable.
12,200.
12,200. You add these two, must equal what you get here. So over there we're looking at 167, right?